In this week's update, are we back into rally mode? Big tech earns its valuation and the outlook for silver. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, let's start with the appropriate perspective on what's going on around the world. Rate cuts is still the biggest game in town in terms of influencing the market direction. So it's whatever the analysts and the crowd thinks is going to happen with rate cuts in the US, that is going to be the dominant theme. I was thinking last week that big tech earnings growth could perhaps take over in that influence, but we've had some pretty good tech results, and the market is still pretty nervous about whether we're going to see any rate cuts or not. And I guess that makes sense because so much of the gain that we've seen in the last 5 or 6 months was about the expectation of rate cuts. So that's where we sit at the moment. Jeremy Powell went fairly light during the week. He could have been a lot firmer about the rate policy over the next 6 months, but he went pretty easy on it, and that was enough for the market to rally. And of course, we got some news that was favourable to the market on Friday night with the non-farm payrolls that came in light, and again got people thinking that the Fed would still be able to cut rates this year. Big tech growth earnings have been generally pretty good, so it's really just a matter of them continuing to deliver to expectations. And it's always difficult in advance to know what the market really expects, because we saw terrific results from Google and got rewarded. We saw earnings and revenue beat from Meta, and Meta got slammed. So you never quite know what the market is expecting. But as long as you're focusing on where the business is going rather than where the price is going, then you're going to be in much better shape. So what we've seen over the last couple of weeks with technology has been massively, and not only technology, but across other areas of the US market as well, hugely diverse reactions to earnings. Some good, some very bad. But if your targets are well researched, then generally the reactions have been pretty good. Now, the US economic data, as I said, came out on Friday night, and it was perceived by the market to be good news. The labour market is slowing, and so the market cheered about that. The key thing from here on is the market breadth. We don't want to see continued leadership by just the biggest tech stocks. We want to see mid and small caps joining in. The market breadth has started improving again, and it's vital for the market to continue. So that's one that we need to watch fairly closely. Turning to the American stocks, the S&P rose 0.5% across the week, but the Nasdaq helped with really good gains on Thursday and Friday. Finished up 1.4, so a pretty good week. So far with the US earnings season, 77% is the current beat rate on earnings. And interestingly, the big tech earnings are up 44%. So they really are justifying their valuation, because that's an amazing effort for such big companies to be delivering that sort of earnings growth on an ongoing basis. So you'd be very hard pressed with a straight face to say that big tech is overvalued. As I said, mixed earnings results and reactions has certainly been a bit of a hallmark of the market. You can help cover that up, if you like, by making sure that you don't buy into excessive price moves. So if you're buying into retracements in the market, then you at least minimize the impact of the market reacting badly to a particular earnings result. So overall, my view is that the American earnings season across the whole market has been good enough to sustain positive sentiment. And that was the danger, that we would see a sudden reversal, given that the rate cut picture has changed so much in the last 3 or 4 months, that sentiment would turn positive. And of course, sentiment in America dictates where everybody else in the world goes. So it's good enough for positive sentiment, and that means that we're not going to have headwinds for stocks that should otherwise rise. That's the good news. And that's really what I was hoping to get out of US earnings season. US dollar index slipped a little bit down to 105. The 10-year yield also backed off. It's come off quite a bit from the peak of a week or two ago. And the VIX is now back down to 13.5. Let's go to the charts. This is the S&P weekly chart. You can see we had 3 weeks down. The week ending the 19th of April was quite concerted. So April actually turned out to be a pretty negative month by most standards. And that was the worst week of April. Probably no coincidence that it was also the main options expiry week as well. Pretty good reversal the week before last. And whilst we had a dip, we finished well. So we're continuing with the process of higher highs and higher lows. That's about all you need to know about the US market. Now, looking at where the particular money flows are going, NASDAQ versus the S&P, we did roll over a little bit, but certainly found some stability towards the end of the week. The NASDAQ, great gap higher. So that's very positive market action. And we're back almost to the 50-day moving average. Importantly, SMH, we had a decent dip, but we've recovered and we've now formed a probable higher low. We just need to move just a fraction higher to confirm that, but that's probably the case. So you'd have to think that the dip that we've had in the market is quite possibly over. Semiconductors versus the S&P didn't really come off the boil too much. We're pretty much on the all-time highs for that ratio. Turning now to the individual sectors over the last 2 weeks, consumer discretionary, and look at XLK, technology has roared back over the last 2 weeks. So that's a real positive in the very short term. The Australian market, information technology, has also bounced back very strongly, followed by healthcare, finances, and then small caps. And of course, energy and materials have had quite the hard time of it with the oil market coming off, the oil price coming off, and also BHP making that offer for Anglo American. That has certainly hurt their share price a little bit, and hence the materials index. So that's the overall situation for the American market. If we look at the currency, definitely came off a bit in the final couple of sessions, and that has pushed the Australian dollar up to almost 60 or just over 65. So just summarising the Australian market, 65.5 is our dollar. Our index rose 0.5% across the week. One would think we'll have a pretty decent opening on Monday. The stars from the week were lithium and uranium. I haven't said that for quite some time with respect to lithium. And we're also seeing copper is doing well. And copper really is just a huge emerging opportunity. More to say about that in a few slides' time. When it comes to project selection, the best projects are the ones to be in, not the rubbish. Don't try and pick the bottom. Don't try and pick the latest, the latest tip. It's, make sure you get an absolutely world-class project. Yes, you might have to pay a bit more for it, but your odds of success are so much greater that it's worth paying up a bit. So the selection group is very slim, but it's very vital. So this is not yet even close to being a market where a rising tide is going to lift all boats. In any of the commodity areas, I think you need to seek out the best possible projects. And if you don't know how to do that, if you're just relying on a tip here and there or a bit of an article here and there, you're going to find it incredibly difficult to do. So align yourself with someone that's really doing the research thoroughly. Let's just take a quick look at the Aussie indices. This is the ASX 200 on a weekly chart. So we broke out, we've retested the breakout, haven't really fallen away too much, and one would think that the way things are looking, we've got a pretty good chance of advancing next week. Precious metals, gold. In fact, I'm not. I think that is. I think that is the week before figures. Apologies for that. I think it finished at 2302. I think is the number. Silver, it's been in structural deficit for several years. It's only really been surviving without the silver price exploding because of silver that's coming from secondary inventories, a bit like it has been the case with uranium for the last decade. But we're seeing demand continues to increase, predominantly from solar. Plus, as with uranium, it's also reached the situation where the inventories have been rapidly depleted. There's not that much left in the cupboard. So with demand continuing to surge, and there would appear to be very little chance of that demand surge coming off the boil, the outlook for silver, not necessarily next week or next month, but the outlook for silver over the next couple of years looks pretty good. And because silver is largely a byproduct of mining gold or copper, it's really the primary focus. So it's actually hard for money investments to really focus on raising the situation or raising the output for silver, because it's just a consequence of other demand signals that the miners are getting. And that number in Australian dollars is not correct either. Sorry, I just didn't amend those from last week. But 2302, I think, was where we finished. So we gave up another $35, $36 last week in gold. If you look at the global situation for gold stocks, leveraging the developers, so tapping into the increased value in the project, not relying on the gold price, is still the key. And I've been, speaking about this now for multiple years, and I'm convinced it's just the only way to make a really good return in the gold market while keeping your risks fairly moderate. Let's go and take a look at that market, and we'll start with silver. This is the silver price. If we put this on a weekly chart, you'll get a better view. So we're still sitting around about the same level that we were at in August of 2020. So getting up towards the 4-year mark, where not a lot has changed, but certainly the circumstances for silver have improved. So we got a breakout. We've now had a retest virtually precisely to the breakouts. Very volatile last week, as you can see, all over the place. But the outlook for silver does look better. Gold on a weekly, 2303, 2304 is where we finished. But again, quite a lot of volatility last week. And if you look at that in Australian dollars, we finished at 334.88 was the finish in Australian dollars. So that is precious metals, lots of opportunities there. Other commodities, copper, steady, 457. So was nickel at 859. Now, the International Copper Study Group, and I can't speak to the credentials of that group, but one would think they know their stuff. They have now reduced their copper surplus forecast for 2024 from 467,000 million tonnes to 162. That's a huge reassessment of the surplus. And we've now got multiple major investment banks now calling for a not too insignificant deficit. So how things have changed in just 6 months from a substantial deficit in 2024, a substantial surplus in 2024 to Now, most analysts are now pointing to a deficit. So you would think copper prices have got to continue to escalate from here, and we're seeing major investment houses talking $6 plus over the next couple of years for copper. So that bodes very well for these really high quality, world class projects, because one of the key things they need to do is to get finance. And at $4, they're going to struggle to get finance. At $5 plus, the finance is going to come much more readily. So that de-risks these projects very significantly. We've had a bit of a sharp pullback in copper. It was trading quite a nicely higher during the week and the previous week. Important support at 440. So copper does need to hold above 440. It should, based on the fundamentals. We'll have to wait and see. Again, the preferred method here is not to buy into breakouts, buy into the periodic bits of weakness in copper stocks. Crude oil has dropped quite a bit, down to 77.9, was the steepest weekly loss in 3 months, largely about OPEC appearing to be, some of the members of OPEC breaking ranks and increasing production. And so the expectation is that may continue to happen, which will put downward pressure on the oil price. If we look at other commodities, the big news, I guess, not unexpected, but the big news in uranium was a US ban on Russian uranium imports into America. It's a little bit foggy how that changes the price of uranium and how that changes the price of uranium stocks, because there's multiple moving parts happening there. But it's certainly not a negative. That's for sure. It's got to be a net positive, but the degree and the timing of that net positive is a bit unclear at this point in time. But look, uranium stocks liked it. They went up in America right through into the end of the week, and they went up in Australia as well. We had a very good couple of days with uranium. The fundamentals around the uranium market just keep getting brighter and brighter. So the long-term outlook for uranium stocks is still very, very good. There's the spot copper chart. You can see we're up around 4.7 a week or so ago, but back down to the 4.5 area. But you can see that we're in quite a steep uptrend since the last consolidation. There's nickel. It's definitely improved. Again, this is a very tricky market. What is happening in Indonesia with exporting of nickel? What is happening in China? It's a very uncertain market. So it's one that I just preferred to stay out of. There are so many commodity markets, such as copper, for instance, where the outlook really is very robust, that I don't need to go and try and play in nickel. I don't need to try and, pick the bottom in some nickel stock. There'll be lots of commentators out there that are trying to do that, because I guess that's what they get paid for. But gee, you really want to go where the high probability is, and I just don't see the nickel market as being that. It's just not a high probability market. Too many uncertain things. And there's the crude oil market, came off quite sharply. We're up around 87 only a couple of weeks ago. So it's given back about $10. And there's the lithium carbonate market, has improved a little bit. When it comes to lithium price charts, I really can't tell you that this one is representative of what's going on. I don't know that anyone knows for sure. These markets are all immature, and it depends a bit on the data that you use. But for the worth of it, there is a chart from Trading Economics on lithium carbonate. But I would say one thing, that the prices of established producers in Australia, and also to a degree in America, are looking better. So either those stocks are moving prematurely, or we have seen the bottom in the lithium market, and the market is sensing that. All right, wrapping it all up, what to do in this May through to September period, which is traditionally, historically, the weakest time of the year. You tend to get a decent July in there, but May, June, to a degree, August and September. But May, June and September are typically the three weakest months of the year. But before you pull the covers over your head, that's at the index level. Individual stocks can do and are doing very, very significantly different things to the index. So please don't mix up the sentiment around the index with the target stocks that you might have. If you've got well-researched, good, well-performing businesses that have gone through a dip in price, you can buy them on good valuation, but fundamentally and technically, then there's absolutely no reason not to do that. Just keep the focus on strong and highly probable growth in revenues and earnings, preferably stocks that are already profitable. Maybe B, because this is maybe a bit more volatile time of the year, be a bit more conservative, hold a bit more cash. But, this is nothing drastic. And most importantly, if all the boxes are ticked, then just buy it. Because in any weaker period of the market, some stocks go up. So why not the best of the best? So that's sort of my wrap on where we sit now, looking at over the next 3 to 4 months. Portfolio analyst last week, we looked at copper, silver and gold, which was pretty appropriate for what was going on, and lots and lots of good opportunities. Well worth having a look at portfolio analyst, but I would do it through the lens of not trying to just, nick a couple of tips, because getting tips is just a waste of time, really. If you don't have a plan and you don't have a process, then those tips are almost worthless because you have no idea how to enter them. You have no idea how to manage them. The main reason you should be going into portfolio analyst is to evaluate the processes that I use, that if you apply them with discipline and patience, work really well. So, if you want to expand your education, then portfolio analyst is well worth a visit. $1 for a 2-week trial. That's it for this week. There's more information on the website. Here's my email address, and I'll be back with you next Sunday. Cheers.